Today we have an exciting topic. We're going to discuss the top 5 dividend-paying stocks held by the legendary investor Warren Buffett's Berkshire Hathaway, and whether these stocks are good buys today for dividend investors. Hello, Dividend Stockpile community. Welcome back to the channel where we deep dive into dividend investing and help you build your stockpile wealth. Berkshire Hathaway just released their updated 13F form, which is a required disclosure to the SEC showing the names and percent ownership of their public stock holdings. With this updated list, I thought it would be a fun exercise to review the top 5 largest holdings and if they are good values to buy today as a dividend investor. So sit back, relax, and let's get started. Berkshire Hathaway, led by Warren Buffett, is one of the most successful investment firms in the world. Founded in 1839 as a textile manufacturing company, it transformed into a holding company under Buffett's leadership in the 1960s. Today, Berkshire owns a diverse range of businesses and holds significant stakes in many publicly traded companies. Buffett's investment philosophy focuses on long-term value investing and choosing companies with strong fundamentals. Among Berkshire's vast portfolio, there are several dividend-paying stocks that stand out. Let's take a closer look at the top 5 and analyze their performance, business models, and dividend histories. First up is Apple, the tech giant that's become a household name. Apple is Berkshire Hathaway's largest holding, making up around 30% of the portfolio. Apple's business model revolves around its popular products like the iPhone, iPad, Mac, and its services segment, which includes the App Store, iCloud, and Apple Music. Apple's ecosystem creates a strong customer loyalty and recurring revenue stream. Apple has shown impressive financial performance with strong revenue growth and profitability. Over the past decade, Apple has also returned substantial capital to shareholders through dividends and buybacks. Currently, Apple pays a modest dividend yield, currently at 0.45%, which might not seem high compared to other dividend stocks. However, its consistent dividend growth of around 5.5% a year and massive cash flow used for share repurchases make it a reliable choice for dividend investors, albeit a low-paying dividend. Some of the pros: they have a strong brand, diversified revenue streams, and consistent dividend growth. Some of the cons include a lower dividend yield and the tech sector volatility. So, is Apple a good buy today? Given its robust financial health, brand, and growth prospects, Apple remains a solid long-term investment. However, if you're seeking high dividend yields, you might want to balance it with other stocks. Some quick valuation metrics to determine if it's a good value today. The first one we'll use is dividend yield theory, which takes the current dividend yield over the last 12 months and divides it by the historical dividend yield. So in the case of Apple, the current yield is 0.46%, and the 5-year historical average dividend yield is 0.68%. So taking those two figures together, it looks like, based on that theory, Apple is overvalued by about 67%, and the current value or the current price of the stock should be around $150. Now remember, no single valuation metric is perfect, so it's important to take a look at multiple analyses to get a better sense on the pricing. Next up, we'll have the PE mean reversion, so price to earnings mean reversion. What this is saying is that over time, quality companies revert to the average PE. Sometimes it can be higher, sometimes it can be lower, but over time it gravitates back towards the average. So looking at Apple, the current PE is 33.02, and the 5-year average PE is around 27. So if you take a look at that, it's approximately 22% overvalued right now. And given their upcoming earnings per share estimates of $6.71, current value should be around $181.71. Finally, we're doing the discounted cash flow analysis. And while it is possible to calculate this yourself, it's a lot easier to use online tools. So I went ahead and used a tool from gurufocus.com. And so here, the Apple discounted cash flow valuation, giving a 7.7% growth over the next 10 years, and then a terminal growth of around 4% into perpetuity, says that the company is currently heavily overvalued, and the fair value, according to the discounted cash flow analysis, would be around $98. So given all those estimates and the current price of Apple, it does not appear that it's a good valuation today. Not to say that it's not a great company or that it will do well in the future, but if you're valuation focused, it may be better times than now to buy Apple. Next, we have Bank of America, one of the largest financial institutions in the world and a major holding in Berkshire's portfolio, coming in around 15% of the holdings. Bank of America provides a wide range of banking and financial services, including consumer banking, wealth management, and corporate banking. Its extensive network and diversified services contribute to a strong market position. The bank has demonstrated solid financial performance with consistent revenue and earnings growth. It also offers a relatively attractive dividend yield of 2.70% compared to the broader market, which is around 1.1%. Bank of America has been steadily increasing its dividends payout with a 5-year average growth of 9.86% a year, making it an appealing choice for income-focused investors. Some of the pros there have the dividend yield is attractive, a strong financial position, and diversified revenue streams. Some of the cons of Bank of America is the exposure to the economic cycles and regulatory risks that are inherent in banking. So is Bank of America a good buy today? With a strong dividend yield and growth potential, it's a compelling option for dividend investors, especially given the size and importance of the Bank of America in the banking and financial services industry. Going back to our same valuation metrics that we use for Apple, the dividend yield theory says it is currently undervalued at around 11%. So the fair market price based on dividend yield theory should be around $43 and is trading at about $38.81 today. For PE mean reversion, it looks like it's approximately fair valued or slightly undervalued at 0.95% undervalued based on the price to earnings. And looking at the discounted cash flow, given the expected growth rate of 4.1% over the next 10 years, it looks like the fair value is around $34, which does say that it is a little overpriced based on this metric. Third on our list is American Express, a leading financial services company known for its credit card, travel, and expense management services. American Express's business model is built on a premium brand and an extensive network of cardholders and merchants. The company benefits from a strong consumer base and significant market share in the premium credit card segment. American Express has shown consistent financial performance with steady revenue and earnings growth. It pays a meager dividend of 1.17, lower compared to other financial stocks. But the company has been increasing its dividend payouts on average of 10.76% a year, making it an attractive option for long-term dividend growth investors. Some of the pros for American Express is the strong brand, premium market position, and dividend growth potential. Some of the cons are economic sensitivity due to their customers' debts on the books and competition from other financial services. So is American Express a good buy today? A strong market position and growth potential make it a solid choice for long-term investors, though it's important to consider economic factors that might impact its performance. Looking at our valuation metrics, dividend yield theory says that it's currently about 11% overvalued and should be priced around $216.95. And the PE mean reversion shows that it's approximately 2.9% undervalued, and the fair value today should be around $250. Looking at discounted cash flow, using a growth rate of 8%, which is the upcoming expectation, it looks like the fair value is around $194, so it shows that it is overpriced today based on discounted cash flow. All right, moving on, we have Coca-Cola, one of the most iconic brands in the world and a staple in Berkshire Hathaway's portfolio since the 1980s, now a 9% holding in the portfolio. Coca-Cola's business model is centered around its vast beverage portfolio, including its flagship Coca-Cola brand, as well as other popular drinks like Sprite and Fanta. The company's extensive global distribution network ensures its products reach every corner of the world. Coca-Cola has a strong record of stable revenue and earnings, driven by its global brand strength. It also boasts an impressive dividend history, with over 50 years of consecutive dividend increases. The company's consistent dividend growth history, around 3.65% a year over the last 5 years, and solid dividend yield of 2.83% make it a favorite among income investors. Some of the pros of strong brand, extensive global reach, and reliable dividend growth. The cons are slow revenue growth, competition from health-conscious trends. So, is Coca-Cola a good buy today? Despite some challenges, Coca-Cola's strong dividend history and global presence make it a reliable choice for long-term dividend investors. Looking at dividend yield theory, we're showing that it's currently about 7% overvalued, and the current price should be around $63.78. And for PE mean reversion, we're looking at about 4.8% undervalued, and the current price should be around $71.90. Looking at discounted cash flow with a growth rate of 4.83% for the next 10 years, it looks like it's currently overvalued on this particular metric, and the fair value should be around $35. Last but not least, we have Chevron, one of the world's largest oil and gas companies and a key holding in Berkshire's portfolio, coming in at 6.63%. Chevron's business model expands exploration, production and refining, and marketing of oil and natural gas. The company's integrated operations provide a stable revenue stream even amid fluctuations in energy prices. Chevron has delivered strong financial performance and offers a high dividend yield of 4.52%, making it an attractive choice for income investors. The company also has committed to maintaining and growing its dividend payouts with a 5-year average of 6.33%. With a substantial dividend yield and stable cash flows, Chevron is a reliable option for dividend investors, especially those looking for exposure to the energy sector. Some of the pros include the high dividend yield, stable cash flows, and their integrated business model, and the cons are exposure to oil, price volatility, and regulatory risks. So, is Chevron a good buy today? With a strong dividend yield and stable financial performance, Chevron is a compelling choice for investors seeking income and diversification to the energy sector. Looking at our valuation metrics, dividend yield theory says it's about 2% overvalued, and the current price should be around $141.77. And using PE mean reversion, it shows we're about 2.4% undervalued, and the current price should be around $148. Going back to our discounted cash flow, using a growth rate of 5%, which is the expectations, it looks like the fair value is around $149.57. And so it shows us about 3% undervalued right now based on that metric. And there you have it, the top 5 dividend-paying stocks held by Berkshire Hathaway. Each of these companies offers unique strengths and potential for dividend income. As always, it's crucial to do your own research and consider your own investment goals and risk tolerance before making any investment decisions. If you've enjoyed this video and found it helpful, please give it a thumbs up, subscribe to our channel, and hit that notification bell so you never miss an update. And let us know in the comments which of these stocks you're most interested in, or if there are other dividend stocks you'd like us to cover. Thanks for watching, happy investing, and keep building that dividend stockpile.